Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number 1 from Corelogic on the 29th of August, brighter future for small investors and relocating owner-occupiers as market conditions shift. Topic number 2 from the New Zealand Herald on the 27th of August, 2025. The year house price rises revert to normal, BNZ says. Topic number 3, NZ Herald on the 28th of August, the KiwiSaver fund that has returned nearly 400%. Topic number 4 from interest.co.nz on the 29th of August, housing market downturn is helping first home buyers get into a home of their own. Topic number 5 from RNZ on the 28th of August, capital income tax, just an internal debate at this stage. Chris Hipkins. Topic number 1, Corelogic on the 29th of August, brighter future for small investors and relocating owner-occupiers as market conditions shift. In a recent analysis, Corelogic's chief property economist Calvin Davidson reviewed key trends in New Zealand's property market, highlighting the continued strength of first home buyers and a lull in market activity from relocating owner-occupiers and mortgaged multiple property owners. He also noted early signs of new investors gradually returning to the market. Davidson observed a growing interest in new build amongst multiple property owners, spurred by tax advantages and less stringent loan-to-value ratio, LVRs, and debt-to-incomes, or DTI, rules. Since 2020, multiple property owners have increased their share of new build purchases from 25% to over 30%, a trend continuing through 2023 and 2024. First home buyers are also becoming more active in this sector, benefiting from lower deposits and the availability of cheaper townhouses. The data also suggests that new investors, those with 2 properties, are showing renewed interest in the market, driven by falling mortgage rates and favourable tax conditions. However, larger landlords with 10 or more properties appear to be holding off on further investments. Movers to make a comeback. Relocating owner-occupiers have been relatively quiet due to market uncertainty and financing challenges. However, those who have moved are showing distinct trends. Downsizing remains significant, while upsizing has gained popularity in 2024. Davidson suggests that weaker markets can be advantageous for upsizing, as sellers might take a hit on their current property but find bargains on the next purchase. First home buyers continue to be a significant force in the market, with 73% of their purchases in 2024 being standalone houses at a median price of $695,000. Movers, in contrast, are buying homes at a median price of $875,000, while multiple property owners tend to focus more on smaller dwellings like townhouses, with their house purchases averaging $806,500. Davidson predicts that first home buyers will remain strong in the market throughout 2024, bolstered by access to KiwiSaver and low deposit lending options. Meanwhile, as mortgage rates and rental yields converge, more investors could re-enter the market, particularly in existing housing stock, though new builds will continue to attract those constrained by debt-to-income rules. The pent-up demand among movers could also lead to an increase in activity over the next 12 to 18 months, as owner-occupiers sell their homes more quickly and shift into new properties. My thoughts on these trends are also that, multiple property owners, especially if they've got mortgages, they would have been constrained over recent times due to bank lending criteria, with provable income testing all of their mortgages at interest rates up to approximately 9%. So with interest rates now on the decrease, that could free up some borrowing capacity for property investors who are looking to grow their portfolio further. Topic number 2 from New Zealand Herald on the 27th of August, 2025, the year house price rises revert to normal, BNZ says. BNZ predicts house prices will remain stable through 2024, but rise by 7% in 2025. Chief economist Mike Jones explained that as interest rates decline, demand and housing activity will increase. Initially, however, this demand will likely absorb the higher volume of homes on the market, preventing further price drops. Real Estate Institute data showed that July had nearly 1/3 more homes listed for sale than the same month last year. Despite this, Jones anticipates a modest upswing in prices by the end of the year. Although the labour market may weaken over the next year, Jones expects lower mortgage rates to strengthen the housing market as the economy improves. He noted that prospective buyers are showing increased interest and confidence, partly due to slightly improved borrowing conditions and diminishing fears of rising interest rates. While the forecasted 7% house price growth may seem significant, Jones emphasised that this is merely a return to the average long-term growth rate at 6 to 7% per year. He added that affordability has improved somewhat due to falling prices, higher household incomes, and now also declining interest rates. Jones also noted that changes in mortgage rates typically take about 6 months to influence house prices. BNZ expects mortgage rates on floating interest rates to fall to around 6% by mid-2025, which would be a decrease down from the current 8%. Wholesale markets have already factored in an official cash rate of approximately 3% by the end of 2025, suggesting that future declines in retail interest rates may not be as swift as recent drops. He added that shorter-term mortgage rates have more potential to fall compared to longer-term rates. BNZ expects the 2-year fixed mortgage rate to drop to around 5% by the middle of next year, with the 5-year rate slightly higher at 5.4%. This would represent a return to the normal upward sloping mortgage curve where long-term rates would be higher than short-term ones. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and would like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Topic number 3 from the New Zealand Herald on the 28th of August, the KiwiSaver fund that has returned nearly 400%. New data reveals that every dollar invested in the best performing KiwiSaver fund from its inception would now be worth nearly $5. According to Morningstar, the top performing fund is Milford's KiwiSaver Active Growth Fund, which has delivered an annualised return of 11.65% and cumulative growth of 385.67%. This means that $1 invested at the fund's launch would now be valued at $4.85. The One Answer KiwiSaver Sustainable International Share Fund followed closely with 375.06% return, while Key Street's KiwiSaver New Zealand Equity Fund was also among the top performers. On an annualised basis, the best performer was Superlife's KiwiSaver United States Large Growth Fund, which grew by 16.2% per year. Greg Bunkle, Morningstar's data director, attributed the strong performance of Milford's funds to its flexible asset allocation, which allows it to adjust risk levels based on market conditions. This strategy, combined with solid stock selection, has led to long-term success. However, he cautioned that while the mandate remains the same, future success is uncertain. Bunkle noted the recent growth of these funds, which benefited from a prolonged equity bull market. The top performers were aggressive funds with a heavy equity focus. One advantage of KiwiSaver is that dividends are reinvested into the fund, enhancing compounding effect over time. He highlighted the impact of long-term investment, describing how the power of compounding, where money generates returns and those returns generate more returns, is now visible in the data. He believes strong returns will continue for equities in a low interest rate environment. Murray Harris, head of KiwiSaver at Milford Asset Management, said that growth funds outperforming over long periods is expected. He emphasised that growth and aggressive funds typically yield better returns than balanced or conservative ones when you're looking at medium to long-term horizons. This reinforces the data that investors should avoid panic-driven switches to conservative funds during market dips. Harris advised investors to stay the course and allow their KiwiSaver funds to perform over time. He stressed that KiwiSaver is typically a long-term investment for retirement, spanning 20 to 40 years, and the data proves that long-term, diversified investing in growth assets is effective. My advice is get advice on your KiwiSaver funds rather than just going to one KiwiSaver provider. Talk to a KiwiSaver advisor, and that's a financial advisor with the investment qualification, and they can help you make the right decision for your specific position and needs and time frame and risk aversion and all that sort of stuff, because there's a lot more to it than just picking the most attractive looking fund at any given time. So if you're a client of Property Apprentice, feel free to reach out and we can help you with that. Topic number 4, interest on the 29th of August. Housing market downturn is helping first-time buyers get into a home of their own. The amount of money first-time buyers are paying to enter the housing market is declining along with house prices. Interest.co.nz reports that in July, the average purchase price for first-home buyers was $655,000, which is a $21,000 drop from July of last year. Since peaking at $718,000 in April 2022, the average price has decreased by $53,000. This price decline has led to smaller mortgages. Reserve Bank data shows that in July, first-home buyers' average mortgage size was $548,000. On average, first-home buyers are now carrying $47,000 less debt than 2 years ago. However, many of these buyers are facing high costs due to low equity loans. In July, 35% of first-home buyer mortgages were low equity loans, meaning that the buyers had less than 20% deposit. Banks charge higher rates for these loans, increasing the monthly payments for these borrowers who are still feeling the effects of elevated mortgage interest rates. The share of low equity loans among first-home buyers has risen over the past 2 years, from 25% in July 2022 to 31% in July 2023, and now 35% in July 2024. In July, 2,583 mortgages were approved for first-home buyers, and this number has remained steady at around 2,500 a month for the past 5 months, similar to mid-2022. This indicates that first-home buyer activity in the market has remained stable, with house prices expected to stay soft and interest rates predicted to continue declining over the next year. More first-home buyers may enter the market as summer approaches. So my advice would be that if you are on a high equity mortgage, so low deposit mortgage, it pays to review this with your mortgage advisor on a fairly regular basis, because as soon as you fall down to at least 20% equity in your home mortgage, then they can remove that low equity margin or lender's mortgage insurance from your loan payments for you. Topic number 5 from RNZ on the 28th of August. Capital income tax is just an internal debate at this stage, according to Chris Hipkins. Labor leader Chris Hipkins emphasises that attention should be on the government's new tax proposals rather than his party's discussion about a potential capital income tax if Labor returns to power. I suspect that's because he knows it's a really unpopular tax amongst New Zealanders. Last week, a Labor social media post highlighted former Revenue Minister David Parker's idea of a capital income tax, or CTI, aimed at taxing high earners whose income isn't fully captured by the current system. And what he means by isn't fully captured means that he's looking at potentially taxing high income earners on money that they haven't actually received, in my opinion. An inland revenue investigation in 2023 found that the New Zealand wealthiest individuals were taxed at rates significantly lower than those of middle income earners, mainly due to income from increasing values of assets like businesses and property being untaxed. I would argue that that's not income if it's not money being received. Like you think of it like this: if it's your home that increases in value and you had to pay tax each year on the increase in that value, how is that fair? It makes no sense to me. Parker resigned from the revenue role after Hipkins excluded a wealth tax from Labor's policy options following Jacinda Ardern's departure. New Zealand is unique amongst OECD countries for lacking a comprehensive capital gains tax. The social media post described the CTI as neither a CGT, capital gains tax, or a wealth tax, but provided minimal details on its structure or implementation. Now we're splitting hairs, aren't we? Hipkins mentioned to Morning Report that Labor has not finalised any policy and that internal discussions are ongoing. He noted that the party is re-evaluating all options post-election, including broader economic policies. National Finance spokesperson Nicola Willis questioned why Parker, no longer holding the revenue portfolio, was commenting on tax matters. She highlighted that Labor had been vocal about new taxes, while the current government has also introduced new revenue measures, prompting her to call for transparency about these proposals. Labor's prior wealth tax plan was intended to be fiscally neutral, redistributing tax burdens without increasing overall government revenue. It included a tax-free zone for earnings of up to $10,000. Hipkins advocated for a realistic conversation about whether additional tax revenue is needed to balance the budget, criticising the current government for lacking a clear plan to address ongoing deficits. He refrained from committing to whether Labor would propose a neutral or revenue-raising tax plan in the next election, noting that National has already suggested new revenue measures. Regarding electricity prices, Hipkins did not commit to breaking up electricity gentailers, but suggested it could be an option. Transform your property investment journey today. Register now for our free How to Succeed with Property Investing event and get expert insights, proven strategies, and exclusive tips to elevate your investment game. Secure your spot today. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and register for our events. Alternatively, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website, and I promise we won't talk about politics again. Thanks for listening.